The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Meanwhile, VC firms have invested $4.4 billion in crypto startups in the third quarter, a 37% decline from the same period in 2021, according to PitchBook data. Joining us now to discuss is Arjun Sethi. He's the CEO and co-founder of VC firm Tribe Capital with $1.5 billion in assets under management. Welcome to the show, Arjun. So we see that crypto startup funding is at its lowest level in more than a year, according to this PitchBook data. Are VCs getting cold feet?
Thanks for having me. I think what you typically see in these types of cycles is a herd mentality and momentum towards things that are a little bit more proven out. So brick and mortar, traditional business models, sort of intrinsic value of products that sort of make money through transactions. So you're seeing a little bit of a retreat from what I'd call a FOMO herd mentality towards we should just invest in Web3 or gaming, which is what you saw with sort of the NFT blow up in 2020 and 2021.
Mm-hmm. And, just following up on our previous conversation, we were talking about this exploit on Mango. This report from Morgan Stanley saying that crypto is becoming less decentralized. I wonder, your thoughts around the latest developments.
I think if you use the framework of the traditional internet where, you in the past when we went from ARPANET to TCP/IP to Netscape to Yahoo to Facebook, all of this transition over the last 30, 40 years, you saw decentralization to centralization. And then you saw fragmentation. I think the right way to think about crypto markets is that you have protocol layers, you have liquidity layers, you have from Bitcoin to Ethereum to ICOs to DeFi. So you've seen this evolution. And I think you've naturally seen some centralization and you've seen some natural fragmentation and decentralization. So the way to think about it is it depends on the chain and what that growth looks like. I tend to think through in like 1994, we had about 30 million devices. Today, we have about $46 billion connected devices. And so it's multiple touch points. There's a fragmentation of usage, and then there is a centralization of how you serve those customers. And on the crypto side, if I take a look at all chains, I think I'm not exactly sure how many wallets you have today, but you had roughly 100 million. And if you were to dedupe those customers today versus what it might look like over the next 20, so I'd call it, 5, 10, 15, 20 years, what does the market actually look like? That's the way in which I would think about what's going to be decentralized versus centralization. Previously you talked about, the Mango exploit. I think what's really interesting about DeFi and what's something that people tend to get scared of is that you see these exploits happen very quickly, but you see it happen in a very transparent way. And you see it happen where everyone is able to take a look at what happened or transpired over 48 hours to 72 hours. If you take a look at what happens in exploits with banks, centralized finance, it doesn't take hours or days. It takes months and years in some cases in order to find out what happened.
That's a good
point. You have a quite a bit of money. Business Insider says you're planning on pulling in another $400 million fund. I don't know who leaked it, but I'm guessing it might have been somebody in your office. That's just me. But where are you putting your money? Where exactly? Where are you finding value right now? Where do you expect the growth to be?
And so when I think about the differences between the public and private markets, we're predominantly private long duration investors. And we invest our capital into what we call our sort of quantitative frameworks of inflection points. So I won't go into too much detail around what that looks like, but our sort of quantitative models allows us to essentially at a very sort of layman's terms, just buy low, sell high. So when you take a look at what's happening in the overall markets, fintech, vertically integrated software products have been sort of predominant. And it's not just here in the United States. You see it in Latin America, you see it in Southeast Asia, and you see it in places like India. And what's really interesting is now software has different models in the way in which you monetize, right? And here in the United States, we went from software licensing to SaaS recurring revenue, et cetera, et cetera. We had transactional models based on engagement. in the developing worlds, and I think this is what we'll lay into as well in crypto. In the developing world, they don't have as much access to capital, and their payments are more as pay as you go. So, for instance, in Southeast Asia or India predominantly, even when you use the internet or access to mobile, you would charge it up and you would pay as usage sort of went up. It's very, very similar to how you think about getting Amazon Web Services. So it's based on usage and engagement. When you think of software products that they're building there, it's the same thing, which is you can have vertically integrated agricultural products, but then you need access to capital. And so you'll monetize through lending or payments, invoices, factoring, et cetera. And when I think about innovation there and the speed of growth there, I think about a lot of these emerging markets. And because that's happened and expertise has continued, you're seeing the same thing happen in crypto, which is a lot of DeFi protocols, a lot of expertise is being built and engaged outside the United States, which I think is a larger issue from a global macro perspective.
You know, we talked a little bit, and you mentioned a little bit about some of these exploits, but it seems to suggest a lot of the weak points in the past few months, particularly, seems to be in the interoperability world, and this whole idea of the bridges being a kind of the weak point here in crypto that gets the most exploitation. Do you avoid investing in such protocols? Have you been shying away from it, or are you how are you looking at it?
I think the right way to think about it is whenever you have a on-road and on-ramp from centralized finance to decentralized finance, there's some issues with the human in the loop. And I think that's always been the biggest issue. And so between bridges, inter-blockchain communication, I would say that we're doubling down and tripling down on anything that's going to be permissionless innovation between chains and within chains. So for instance, we started on Tribe Crypto Labs team. We've incubated a couple of projects on the Cosmos chain, some on Ethereum. But if I take a look at some of these new alternative chains and what you have the ability to do, you're just augmenting permissionless innovation so that there's no human in the loop and so breakages can't happen. It's not to say that these are going to be perfect systems, but I actually believe they get more closer to perfection in that ecosystem where you have less and less exploits, or you're able to see a very transparent model where you can sort of fork, get instant feedback loop, create something new, and get to a place that's better. And if you go back in time, you take a look at Terra, you look at the DPEG, those instances of events that happen in that timeline, again, give you a very clear structure of what not to do versus what you can do in the future, and what a very elegant ecosystem can look like for permissionless innovation.
So speaking of getting the human out of the loop, my understanding is that your approach to investment is data-driven. And I think that raises a question just about, investing in some of these early stage, mid-stage startups in a industry that is kind of like early stage, and a lot of these technologies are still unproven. A lot of these ideas are still visions. They're not really they haven't reached mass adoption anyway. So I'd be curious, how you describe this data-driven approach. What data are you using? Most VCs we get on the show, when we ask this question, they just say the team. That's their answer. We invested in the team. I imagine your data is a little more sophisticated than that, but I'm curious if you could break that down.
Yeah. So if you go to our website, you can just take a look at the way in which we think about engagement. But the best way to think about it is Facebook, Square, Snapchat, Twitter, Slack, Airbnb. All of these companies, what do they have in common is you had customers on one side, and then you had the company on the other side. So it's a traditional software play. Now, what happens? You can have a company like Workday, which is selling to one company, but has thousands of customers underneath that, which are the employees, and they engage with software. Or you can have a company like Facebook where you come in and you engage day 1 to day 30. And so there's the N number of times that come back and you can measure that effect. Now, if I take that to its most extreme, what you're able to sort of take a look through is how does product market fit sort of elate itself with customers engaging with that software. Now, that's traditional software. In crypto, you have on-chain and off-chain data. So you're able to see the ledger and you're able to see the engagement on top of what I'd say trade secrets of software. When you're able to put these two things together, you are not looking at just one company, but you can take a look at 10 companies, 100 companies, 1,000 companies. So similar to accounting frameworks, you're able to come up with your own quantitative models around how customers engage and where they are in that life cycle of risk. And that's how we take a look at where they are. So the earlier, where there's no software, is just a team and it's a market and they're thinking about building a product, there's no quant model to take a look at because they haven't built anything. But the moment you have your first customers, the moment you have your first user coming in, you have engagement data and you can start taking a look at those frameworks for everything that they do, given that it's software. And software has its own data exhaust that just gets thrown somewhere. So I'd argue for every company that's building software from one customer to an end of 1,000 customers, you have the most sort of beautiful data lakes that you can get access to and start coming out with your own underwriting risk models.